Welcome to Trader TV Fixed Income, your insight into the trading climate for professional bond investors. I'm Dan Barnes. In April's show, we'll be examining the concept of best execution as promised by regulators, the rather stark transaction cost reports that the rules of making funds publish, and we'll be asking how investors can make sense of them. I'll be talking with Carl James, Global Head of Fixed Income Trading at Pictet Asset Management, about trading costs and best execution, and Gherardo Lenti Capoduri, Head of Market Hub at Banca IMI, to assess the success of the best execution regulatory regime. Market data is provided by MTS. Carl, welcome back to Trader TV.
Thank you.
So today we're going to look at the difference between transaction cost analysis and best execution outcomes, and to talk a bit about the way that best execution can be quantified. Now, to start off with, it would be useful if we could get an understanding of the difference between fixed income best execution and best execution in equities and the way they're managed.
Equities is really, it's a single asset class. You may have some changes in voting classes, but broadly, an Indonesian equity is like a German equity, is like a US equity. So, it trades in a similar way and you can measure it in a similar way.
Sure.
If we think about bonds, bonds have various different characteristics, whether it's maturity, whether it's rating. It depends on how it's been issued.
Yeah.
So there's various different ways of how it's traded and therefore how we should assess the effectiveness and efficiency of the execution. We need to make clear that differentiation, and I think with the regulation that's come in, MiFID II specifically, and PRIPS and KID, there's been a little bit of a drive for saying, oh, actually TCA is in equities, we should lift that up and pop that onto fixed income.
Yes.
I think we've got to be aware that that won't work. And the more forward-looking people in the fixed income industry say, TCA works for equity, that's fine, and they go down that route. We're looking at a best execution analysis where we take apart the component areas of the process.
So when one's looking at best execution, what are the different elements, including cost, that one has to consider?
MiFID I talks about best execution, and that's really the only place where there's any definition of best execution anywhere.
Yes.
So it's about the price is obviously important, but actually it's the cost as well, and I think that's back to your original point, the cost. So there's implicit costs and there potentially could be explicit costs. But again, it depends which instrument you're looking at under the umbrella of fixed income.
Sure.
There is the speed of execution. So if you have an at-market order and it takes you 4 hours to execute that, is that a good outcome? Is that a bad outcome? It depends, because if it only trades once every 10 months, that could be a very good outcome.
Yes.
But it's the speed of execution is a factor as well. The likelihood of execution and the likelihood of settlement is something else that we need to take into account, because that's partly to do with counterparty risk. So there are a number of elements that you've got to take into account when you are reviewing your process. So have you achieved best execution?
There seems to be an assumption that one will always be able to execute, as there is in very liquid equity markets.
Yeah.
And that's incorrect, isn't it?
Yes, I think it's about understanding who invests in bond markets.
Yeah.
So traditionally or historically, if you like, it was a buy and hold market. So
Yeah.
you'd have insurance companies, managing assets versus liabilities. They'd buy a bond and hold it to maturity. So actually, and again, there is some nice academic work that's gone to demonstrate the percentage of bonds that have been issued and how much has been held, never traded, to maturity. And it's a very high percentage of that issuance.
Yeah.
Now, what that means is that reduces, if you like, the free float, to use an equity term.
Yeah.
So what we're seeing is, and I need to quote here from Green, Holyfield and Scherhoff. They did a paper in 2004. So on average, a bond trades 6 times in the first 10% of its life. Now, halfway through to maturity, that same bond, on average, will trade less than once in every 10 months.
Wow.
So if you think about that, once every 10 months, you can almost say it's once a year.
Yeah.
So in terms of trying to find that liquidity, if you like, that's an enormously difficult thing to do.
Yes.
And that's why I think fixed income analysis of the best execution outcomes is very complex and will be data driven. We're in a really good place now that we're starting to get this momentum of more and more data.
Yeah.
And if you start to capture that, what you'll be able to do is dealers actually doing their job will be able to make better informed decisions because they'll have the underpinnings. So for example, at Pictet what we've done is we've captured 700 days worth of trading data.
Mm-hmm.
The dealers are able to investigate and analyse that on a bond-specific basis, so they can look at a specific bond and see what axis have we come in, what the hit ratio is, what size did we execute, where did we execute, did we trade bilaterally, did we actually go on to an MTF, or how was it actually traded. Now, past performance is no guide to future performance, but it gives a guide. I prefer to have that than nothing at all. So you've got your own historic data. Now you can then layer over the top of that other data from external parties that have actually traded, and that will give you even richer data to make a better informed decision. Now for me, pre-trade is the real place where the hard work's done. When you move to post-trade and you assess and analyse the trading, what I want to be able to demonstrate is that we have got a systematic strategy in terms of understanding why we're trading so much with a particular counterpart.
If we were to look at the actual costs that are involved in a trade, could you break down what the component costs are?
Think about going all the way back to when the order was generated. Within your organisation, you might have an analyst, a credit analyst, for example, that says, I think this bond, we should buy it.
Yes.
Okay. If a portfolio manager doesn't react to that for 20 days, well, have we missed 20 days opportunity? It then hits the dealing desk. Okay, so that's another timestamp in the system. That's at that point, that trade can actually be executed. That's the first time it can be executed.
Yeah.
So we start then to go into the implicit and explicit costs.
Yeah.
The first cost really is about how much time is being saved, and that's in that sense. That's an implicit cost.
Mm-hmm.
So again, it's a small element in the fixed income world.
Yep.
Now, if we go a little bit further, we can start to talk about the complexity of settlement. How do they settle? Mm-hmm. Do they settle with carrier pigeon in the sense of the communication, or is it over phone? Is it fax? Yeah. Or actually is it through SWIFT? Mm-hmm. Is it through other electronic means? Because the more that you can collapse down those costs, the more effective and efficient that whole process will be. So you're data driven, so that when we look at that best execution analysis and the cost, we say from the portfolio manager sending us that to when it was actually executed, we've collapsed that time down to as short a time as possible.
Yeah.
So the cost involved is actually two levels for me. One is the price of the actual, the slippage, if you like, from when the PMs sent that order to when the dealer received it, or the machine actually received it, and it went through the system to be executed. What's the difference? And if we collapse that price, you're going to get very good return in the sense of you are matching the what the PM's expectations are.
How do you see best execution analysis informing the investment process?
So from a dealing desk perspective, we now have data where you can review yourself. Now, intuitively, most skilled and experienced buy-side dealers know when they've not done as well as they could.
Sure.
But if you give them the tools, they'll be able to review and refine. Now, one of the things I see from the regulator is they want to see that process. And what I've found is that you're able to have rigorous data that we can share with the clients, and they get a better insight into how these markets work, and that informs and educates.
Carl, it's great to have you on again. Thanks very much for being on the show.
Thank you.
Now I'm joined by Gherardo Lenti Capoduri of Banca IMI to analyse the best execution regulatory regime. Gherardo, welcome to Trader TV.
Thank you, Dan, for having me.
To start with, I would like to ask, what was the objective of legislators when they set out best execution regulation?
The new regulation is looking to increase across financial markets investor protection, transparency, and competition. Best execution was already a point of attention under MiFID I, but with MiFID II, the concept has been deeply revised, and in a new directory, much emphasis has been placed in changing investment firm obligation to demonstrate best execution when receiving and transmitting and executing client orders. When implementing best execution, as for RTS 27 on MiFID II, first must take account of a number of different factors: price, cost, speed, likelihood of execution, and settlement, size, nature of orders, and other relevant considerations.
That's great. Thank you very much. So we had MiFID I in 2007. Over the last 11 years, how would you say best execution as a concept has evolved?
Okay, it's easy to tell you what is the difference because it's three different simple words. But under MiFID II, investment firms were obliged to take all reasonable steps to achieve the best possible result for their clients. Under MiFID II, investment firms instead are required to take all sufficient steps. This slightly change in the wording of the obligation implies that first may have to make changes to current practice and policies, suggesting a more quantitative and formalized approach to demonstrate best execution. RTS 27, RTS 28 requires trade venues, SI, and market making to publish in a readable format data relating to the quality of execution. However, first report will be published now in April 2018 and in June 18 as well, with reference of 2017 data. In addition, investment firms have to adopt a fairness of price policy and are required to disclose the top 5 execution brokers and venues by volume on an annual basis.
And so if you look at the way that best execution for fixed income trades has changed, how would you describe that change?
Since the introduction of MiFID II, we assisted to a shift from OTC voice towards more electronic executing model on trading venue, either for regulatory obligation, either for accessing liquidity in a more fragmented market, either for a more efficient and standardized executing process. Technology is giving, for sure, a big boost to all these transformations in terms of efficiency, reducing costs, operating costs, OMS, EMS, broad news, and standardized connection. This shift is particularly evident for smaller tickets, while block size tickets are more voice. Until the role of the systematic new role of the systematic internalizer will be in place by the beginning of September. With Market Hub, Banca IMI has already implemented its hybrid models, also in fixed income, with MiFID I introduction, the Italian regulator extended best execution obligation also to fixed income instruments and for retail clients since the beginning. And building a best execution model, aggregating in a single order book, fragmented liquidity, different products, different market model, different type of clients.
Would you say that execution quality has improved as a result of these regulations?
These new rules have the ambitious target to improve investor protection and extended market transparency, mostly in the OTC fixed income market world, while trying to preserve the difference of each single class of instruments, because the types of analytics in the large part are not transferable to fixed income from the equity market. So the so-called equitification of fixed income market is not in place at all. And it will not be in place from my point of view. We are in the middle of a transformation, a sort of a Copernican revolution, which will strongly impact the financial market. Best execution under MiFID II, in particular, consists of a process rather than a simple price discovery. This is evident in particular for fixed income, where if you select the best price, does not necessarily prove best execution. On the other hand, you are proving no worst execution. What regulators are requesting is the process to monitor not only the price quality, it means investors have to establish clear procedures. This is tough in compared to prove only price quality. To monitor the minimum standard built out in the execution policy to demonstrate best execution. When executing clients, in consequence of that, the focus is now on efficiency and on creating a straight-through automatic process, which may better support the quality of the execution, monitoring and reporting, as well as avoiding manual mistake. And help is surely coming from technology innovation and fintech.
That's excellent. Gherardo, thank you very much for your time today.
Thank you, Dan.
I'd like to thank Carl James, Global Head of Fixed Income Trading at Pictet Asset Management, and Gherardo Lenti Capoduri, Head of Market Hub at Banca IMI, for their insights today, and of course you for watching. To catch our reports on equity and crypto markets this month, or to subscribe, go to tradertv.net. We'd like to thank MTS for the market data.